Hey guys, it's me. Welcome back. In today's fast-paced world where quick decisions can mean the difference between success and missing out, it's easy to get caught up in the hype and make impulsive choices. However, when it comes to making sound financial decisions, taking the time to analyze and plan is crucial. So today I want to share with you something really powerful that has the potential to change your financial future. It's called fundamental analysis. Ever wondered how to unlock the secrets of smart investing? Picture this. You're navigating the bustling streets of a vibrant city. You come across a grand old building, the kind that stood the test of time. This structure, much like a strong company, has withstood various economic storms and continues to thrive. But what makes it so resilient? How do you know which companies are the financial powerhouses and which ones are just riding high on temporary luck? The answer lies in understanding the inner workings of these companies, their financial DNA. This is where fundamental analysis comes into play, a key that unlocks the doors to smart investing. In this video, we'll delve into the world of fundamental analysis, exploring its core components and teaching you the skills to spot undervalued gems in the rough. Join us as we turn the pages of financial reports, calculate key ratios, and reveal the secrets of making smart investment choices. So buckle up, grab your magnifying glass, and let's embark on this exciting journey together. All right, let's break down what fundamental analysis actually is. Put simply, fundamental analysis is a way of evaluating a company or asset as true value by digging into its financial health. Instead of chasing after market trends or rumors, this approach focuses on understanding the economic and financial factors that drive a company's performance. Think of it as being a detective in the world of finance, where you sift through clues to find hidden value. But why is fundamental analysis important? Well, in a world where emotions and speculation often take the wheel, this approach provides a beacon of rationality. By understanding a company's fundamentals, you can see through the noise and make informed investment decisions. This means buying or holding a stock not because everyone else is doing it, but because you've done the homework and believe in the company's long-term potential. Now let's explore the key components of fundamental analysis. Understanding these building blocks will help you make smarter investment choices. First up, we have financial statements. These are like a company's report card, providing insights into its financial performance and position. We'll discuss three main financial statements: the income statement, balance sheet, and cash flow statement. Let's start with the income statement, also known as the profit and loss statement. This statement reveals a company's financial performance over a period of time, typically a quarter or a year. It shows the company's revenues, expenses, and resulting profits or losses. Picture it as a snapshot of the company's financial health during that specific time frame. Next, we have the balance sheet. This statement is like a financial photograph taken at a specific point in time. It lists a company's assets, liabilities, and shareholders' equity. Assets are what the company owns, such as cash, inventory, and buildings. Liabilities are what the company owes to others, including loans and accounts payable. Shareholders' equity represents the owner's stake in the company. The balance sheet follows the basic accounting equation: assets equal liabilities plus shareholders' equity. This equation must always hold true, ensuring that the company's resources are accounted for. Finally, the cash flow statement, also known as the statement of cash flows. This statement tracks the movement of cash both into and out of a company. It categorizes cash flows into three: operating activities, investing activities, and financing activities. The operating activities section includes cash from the company's core business operations. Investing activities involve cash spent on assets such as property, plant, and equipment. Financing activities encompass cash from sources like debt, equity, and dividends. By understanding where the company's cash is coming from and where it's going, you can gain valuable insights into its financial health and sustainability. Once you've analyzed the financial statements, the next step is to calculate key ratios. Financial ratios are like magnifying glasses that help you see specific aspects of a company's financial performance and position. They allow you to compare a company's financial data to industry standards or its own past performance. Some commonly used financial ratios include the PE ratio, debt-to-equity ratio, and return on equity. The PE ratio, or price-to-earnings ratio, is a measure of the market's valuation of a company's earnings. It's calculated by dividing the company's current share price by its earnings per share. A high P/E ratio might suggest that the stock is overvalued, while a low P/E ratio could indicate undervaluation. The debt-to-equity ratio, on the other hand, measures a company's financial leverage, or the proportion of debt financing to equity financing. It's calculated by dividing a company's total debt by its total equity. A high debt-to-equity ratio may signal financial risk, as the company has more debt than equity, whereas a low ratio suggests a more conservative approach to financing. Return on equity, also known as ROE, is a measure of a company's profitability. It shows how much profit a company generates for each dollar of shareholders' equity. ROE is calculated by dividing net income by shareholders' equity. A higher ROE generally indicates better financial performance and efficiency. After calculating these key ratios, you'll have a better understanding of a company's financial health, valuation, and profitability. And there's one more piece to this puzzle: economic indicators. Just as a ship needs a compass to navigate the vast seas, you need to understand economic indicators to fully grasp a company's story. These indicators provide a roadmap of the broader economic landscape, allowing you to make more informed investment choices. Think of economic indicators as signposts along the road to financial success. They provide insights into the overall health and direction of an economy, helping you anticipate potential opportunities and challenges. Key indicators like GDP, inflation, unemployment rates offer clues about consumer spending, interest rates, and the job market. For example, if the GDP is on the rise, it may signal a growing economy with more potential for businesses to thrive. Similarly, understanding inflation helps you gauge the purchasing power of consumers and the value of your investments. By staying attuned to these economic rhythms, you'll be better equipped to identify companies poised for growth in the ever-changing markets. Now that you're familiar with the key components, let's walk through the process of analyzing a company. We'll use a well-known company as our example, but the steps apply to any company. First, obtain the company's latest financial statements and annual reports. These documents provide a wealth of information about the company's financial performance, strategy, and future prospects. Once you have the financial statements, start by analyzing the income statement. Look for trends in revenue, cost of sales, and operating expenses. Understand how these factors contribute to the company's net income. Next, examine the balance sheet. Assess the company's liquidity, solvency, and financial structure by reviewing its assets, liabilities, and shareholders' equity. Finally, review the cash flow statement to understand the company's cash inflows and outflows from operating, investing, and financing activities. After analyzing the financial statements, it's time to calculate key financial ratios. As we discussed earlier, ratios like the P/E ratio, debt-to-equity ratio, and return on equity provide valuable insights into a company's financial health, valuation, and profitability. By understanding these ratios, you can better assess the company's performance and position within its industry. Now, consider any non-financial factors that might affect the company's future. This could include industry trends, competition, regulatory changes, and technological advancements. By considering both the financial and external factors, you'll have a comprehensive understanding of the company's current state and future potential. With this knowledge in hand, you can confidently make more informed investment decisions. Remember, in the world of fundamental analysis, knowledge is your greatest asset. So keep learning, keep analyzing, and watch your financial success grow. In conclusion, fundamental analysis is a powerful tool that equips you with the knowledge to make smarter investment decisions. By understanding its key components, analyzing a company's financial health, calculating key ratios, and staying attuned to economic indicators, you can navigate the complexities of the stock market with confidence. And remember, common mistakes can sometimes overshadow the true value of stocks. Always look beyond the obvious. Stay tuned for more insightful tips and strategies. Now, I'd love to hear from you. What's your favorite stock analysis tip? Share your thoughts in the comments below. If you found this video helpful, don't forget to hit the like button and subscribe for more valuable content. And if you're eager to learn more about stock market investing and trading strategies, consider doing more research online, as the internet provides so many free resources for learning. Thank you for joining me on this journey towards financial success. Until next time, keep analyzing, keep investing, and always strive to become a financially savvy investor. This video was creatively created by Creativo Solutions with the use of artificial intelligence. Thanks for watching. See you in the next one.